All right, like I said, welcome to the April webinar. Our topic today is how to answer tax bill questions and certificates of error. So our format is going to be similar to our previous webinars. We're going to start out with a guest presentation. Our presenter has prepared a bit of what she would like to share with you, and then we'll have, like we have had before, Q&A from the audience. Feel free to use the chat. Feel free when we're in our official Q&A to go ahead and unmute yourself as well, and we'll make sure we do our best to get your questions answered. So our presenter today probably is not a stranger to anybody here. We have Chesney Leafblad, who is the Chief Deputy Assessor in Warren Township up in Lake County. Most of you have probably had her in class teaching property valuation. So I will go ahead and hand this over to Chesney to get this started.
All right, thank you. What an exciting topic we have today. It might sound weird, but this is definitely something that I love communicating to taxpayers about. I see my role here as having multiple things that I need to do, but one of them is provide education to my constituents. So you guys know I love doing the classes and I love educating my peers. But also I feel very strongly that there's an education component that we can use to educate our constituents. And when they have a better understanding of how this works, they understand what our little role is in the overall process that can seem somewhat daunting. So the first thing I do when someone comes in the office and they want to ask me about their tax bill is I say, hey, can I give you a little bit of background on the property tax cycle? So your property tax bill is going to be made up of three parts. You have the assessed value of your home, any exemptions that you receive, and then you have the tax rate. So if you think of those three parts, they really happen at the same time, but in different ways. So I like to point out, of those components of your tax bill, this is the part that I'm responsible for as a township assessor. This is the part that I help process for our county assessor. Now, if you're at a county level and you're in a county where you're valuing, you might be responsible for both of those pieces. If you're at the township level, though, in a larger township, you're probably responsible for the assessed value and you might help out in terms of exemptions. You just need to know how that works in your jurisdiction. Then the final piece of the puzzle is that tax rate. So I'm going to talk a little bit about this. And if you've been in some of the classes, you've seen me use this graphic that was put together for my county. So what I tell people is I say, hey, we've got two trains and they're running simultaneously and they don't converge until you're in the tax extension department of the county clerk's office creating the rates. So from our perspective, we've got our assessment going on. We're valuing all the property, sending it to the county. We've got appeals and all of that is happening. At the same time, those small taxing bodies are developing their budgets. One thing that's important to understand here is that the budget doesn't equal, see if I can do it, that's a not equal sign. The budget doesn't equal the levy. The levy is the portion of a taxing body's overall budget that they want to be funded through the property tax system. So if you look at a school district, they are receiving money from the state of Illinois. That's one way that they receive income. They have fees, parking fees, book fees, registration fees that they have. There's probably some fundraising involved as well. So their budget is actually going to account for how they're allocating funds from those various revenue sources. The property tax cycle is just the part of their budget that they want funded from property tax dollars. So that really is an important distinction to make. So they're figuring out what's our budget, how much of that do we need to get from the tax and levy cycle. They have to consider things like their current rate, what the limiting rate is. All of those things are going to look different depending on whether or not you are in a PTEL county or not. So how many of you on this call know what PTEL stands for? I see no hands raising. Nobody's got their camera on. I don't know if you know. Thank you to Glenda and Christine for showing me your beautiful faces. So PTEL stands for.
You got a thumbs up from Colette.
All right, thanks, Colette. Property tax
Okay, I'm just slow on the reaction. Sorry.
limitation law. The property tax extension limitation law. So that's what PTEL is. Now, that will affect how much a taxing body can increase their levy, not their budget. If they're being creative with their revenue sources, it doesn't affect their budget. So I've got Jamie in the chat box. You know that your county is not a PTEL county. So that is something that you should know. If you don't know the answer to that question right now, when we get off this call, I want you to go ask someone else in your county and find out, because you really do want to know whether or not you are. And also, if you can speak to that law, you'll sound smart when you're talking to a homeowner. So that applies to the budget and levy part of the tax cycle. So do we do that? No, that's not part of what we're doing at the township assessor's office or even at the county assessor's office. But it's really important for us to understand, because there's one question we always get, and we've gotten it for years. And that question is, well, isn't there a cap on that? People like to call this the tax cap. So you don't have to understand the nuances and the intricacies of how that works, but you should be able to know whether or not you're a PTEL county. If you're not a PTEL county, there is no tax cap. If you are a PTEL county, you need to know that the cap is in relation to the amount that a taxing body can increase their levy, not a cap on how much their bill can go up, and not a cap on how much the assessment can increase. This graphic is really helpful also in dispelling what would be, I consider to be a common rumor. We talk about this a lot in some of the classes that we take, but sometimes on the assessment side, they say, hey, you are increasing the assessment so you can get more money for the schools. Well, that's not how this works, right? These two processes happen independently, two trains, separate tracks, and then they converge in the county clerk's office where the rates are created. Does anyone have any questions about these two processes before I move on? You can ask questions in the chat box. I've got it open, so I'll see it if you throw it in there, or use the raise hand functionality and unmute yourself. Okay, no questions. All right, so moving backwards, which is somewhere we don't usually go on a PowerPoint slide. Now you can see what I am trying to identify in this chart. So here's the three parts of the bill. You've got the assessed value, you've got the exemptions, and you got the tax rate. And then this is kind of where they're occurring in those two train tracks. You've got the assessed value and exemptions that are being handled in the assessment and valuation track. And then you've got the tax rates that are playing along that budget and levy track. I know you can't see this. We're gonna jump into each section, but we've created, with the help of Tiffany in my office, we created this guide to tax bills for our county. And so when I'm talking to a property owner at our front counter, I'm typically going to pull this out, and it's pretty. So they almost always want a copy to go with them too. So if you do something like this, we've got like our nice laminated one, but they always want a copy to bring with them. So be ready for that. Have some copies printed. So this is what a tax bill looks like in Lake County. And this is helpful because I can use this to identify, hey, there are 3 pieces of your tax bill, all right? You've got your assessed value, your exemptions, and then you've got your tax rate. And then I tell them, this is the part of your tax bill right here that I'm responsible for. This is what I do here in this office at the township level. This part, the exemptions, I'm helping you get the proper documentation and applications submitted to the county because they're responsible for actually approving or denying those exemption applications. And then the tax rate, again, totally separate process. We are not responsible directly for this. You can identify all of the different taxing bodies that levy on these individual properties. Let's take a look at another example property tax bill. So this example is from Adams County. And this is, for me, this is quite a hike. I think it took me 5 hours to get to Quincy, and I'm about 20 minutes from Wisconsin. But again, it is from a completely different area in the state, but it has the same components. They're just laid out a little differently. The formula's the same. You've got your assessed value minus the exemptions times the tax rate is going to give you your tax bill. So you can see the assessed value information here, exemption information, and then your tax rate information. So I see some people on the call that have been around a little, and there are some exemptions that do come off a little earlier here before the taxable EAB is determined. The home improvement exemption you can see on this form. So it's important to know where each of those exemptions live and be able to identify them on the tax bill. Before we deep dive into any of those pieces, does anyone have questions about that high-level overview? All right. So in this imaginary conversation I'm having, but it's an actual conversation I've had again and again and again. So I move on from telling them, hey, 3 pieces, this is the part I'm responsible for. So then I tell them, let me give you a little bit of background about the assessment process. There are many moving parts in the property tax cycle. The assessment is just one part, and basically it's your share of the overall tax burden. So the overall tax burden is driven by the amounts of money that is wanted by every taxing body. It's driven by the levies of every taxing body. And the assessed value is just saying, hey, there's this big, heavy burden. What part of it am I responsible for? And that's what our assessment does. This is your part of that heavy burden. So you all had to pass the qualifying series to become an assessor. You have to have your CAAO. If you're a county assessor, you had another fun test that you had to pass. So you know how to determine an assessed value, but feel free to share that with a property owner. Now, in this scenario, we are going to say that I'm speaking with the property owner at a time past when a CE can be sent in. We'll talk about CEs later, but I'm talking to a property owner at a time where I can't make any changes to the bill. Okay. So what am I going to tell them about the assessed valuation? So the assessed valuation, again, is your share of the property tax burden. We're looking at market data from the previous 3 years. We stratify by neighborhood. So you give them some of those big overall headers of what you do to determine the assessed value. One thing that I always like to do if someone's questioning their property tax bill is say, hey, let's take a look at your property and do a property review. There's a couple people on the call that are currently in our new residential data collection course on its test run. And one of the things we talked about is being able to review a property record card. And so that's something that you should do. You're looking at this is what I do, this is what the value is. Well, let me take a look at your property record card and verify that the property characteristics and information that we have on file for your property are correct. So this is where I'm going to take the time to review square footage, number of garage stalls, how many bathrooms they have, whether or not the basement's finished, just hitting the high notes. I don't get into, exactly what type of roof cover and how many square feet of AC system they have going on, So just hit the high notes here, those things that can really alter the valuation portion of this. And so that's what I'm going to spend some time doing there. Now, if you find an error on the property record card, depending on where you are in the valuation cycle, there's different things that you can and cannot do about it. So we'll talk about that when we get to the CE portion. Any questions on this part? So here are the high notes. We assess based on fair cash value. There's a statutory level of assessment. In Cook County, for residential properties, you're looking at 10%. Outside of Cook County, you're looking at 1/3 of fair cash value, so 33.33%. On the tax bill as well, you'll see where a state level equalization factor can be displayed on the bill. So I have verbiage from when we did have a state level equalization factor in Lake County. And basically we let them know that based on a sales ratio study, our actual level of assessment didn't meet the statutory mandated level of assessment. The factor applied at the state level was to bring that median value to where it should be based on statute. So that's the short answer. If you have a better understanding of equalization, feel free to expand that answer as necessary. Prior to doing that, you should take a temperature gauge, be realistic about who you're communicating with. You have to understand it pretty well yourself, but you also need to understand how much does the person I'm talking to really want to know about this. I've made the mistake of telling them a lot more than they wanted to know, and they kind of left with their eyes glazed over. So kind of step into the explanation. If they start questioning you, you might go a step further and explain that each year's sales ratio study happens independently. They look at sales versus what the assessment was the year before. So you might expand that as needed. Any questions on that or that explanation? Now, some of you that are on the call, you've been around a little bit, so I'm going to switch that. If you don't have a question, does anyone else have a suggestion, a way of explaining either of these things and how that has worked for you in your office? I see someone typing, so I think we've got a suggestion coming in. I think it's important to understand that there are many ways to explain these topics. And I think it's good to hear the explanations that others have. Someone might have found an incredibly simple way to explain a complex idea. And so I really appreciate hearing how other people explain some of these things. So if if we come across something and you've got a good idea or something that's worked for you, feel free to drop it in the chat box as well. All right, so the assessed value, if you're at the township level, that's our main function, right? When I started in this industry, a significant amount of time was spent on the actual valuation process. And then the market crashed and it went crazy and it shifted, and a significant amount of time was spent by township staff in the support or in the appeal function of our role and supporting our assessments that had been contested. And now I'm seeing a shift to where a significant amount of time in my office is spent helping people fill out exemption applications. I mean, we have a lot of exemptions now. So you talk about the assessed value. That's kind of what we do here. And then the next thing you want to talk about is say, hey, we have a lot of exemptions that you might qualify for. So let's take a look at each of those exemptions and make sure that you have everything that you're eligible to receive. So that's kind of the next step. So then you walk through some of those exemptions, the application process for your township. In my county, it is an online process, but the easiest way for them to do it online is to actually come into our office in person. That might be just my opinion, but that way we can help them with the processing side and make sure that they are submitting the correct evidence that's required, the documents required in support of these various exemptions. Making sure they're aware of exemptions that require renewal, so that they don't miss those opportunities moving forward and have to end up dealing with CEs, which is the end of this presentation. Any other questions on this part? When I'm looking at a tax bill with a resident in my office and I pull out my sample here, what I'm likely to do is I'm likely to do something like say, hey, this is what you filled out today. If you don't see a number in this box next year, you need to come in and see what's going on. You know, let's double check. Maybe it fell off. Maybe it got held up. So make sure that you see an amount in that box in the future. All right. So we talked about the assessment being our function. That's the first part of the property tax bill. Then you subtract all of the exemptions that a property owner or the property is eligible for. The final step is to take that taxable EAV, taxable equalized assessed value, and multiply it times the tax rate for that property. Now, if I was really good at drawing, I would draw something here for you that would look really nice. But because I'm not really good at drawing, what I'm going to do is I'm going to share the whiteboard, and you all are just going to put your rose-colored glasses on and pretend like this looks good. So can you see my whiteboard? Okay, good. All right. So you have an individual property. So there's our property. And you have all of these various taxing bodies that levy tax. So we've got our nice square township that levies tax, right? There's a township tax and then there's a township road district tax, right? A separate box. And then, you know, you've got the county, right? The big county, the big county that's going to levy on that property. And then within some property boundaries, you're going to have this school district, big fat boundaries. And then you're maybe going to have a fire protection district. This may be like that goes over here. Oops. Wrong button. Let's go back here. Fire protection district here. And then sometimes you're going to have something like a library that goes right here. And then you're going to have city boundaries. And some of them, you get some even weirder lines. Like this is the city, and they did this, and they come up here. Okay, right? And so if you look at this, maybe we've got another house just over here. Well, guess what? Their tax rate's going to be different. So the way that I explain this to the property owner is that you are going to look at all of the different property taxing bodies that provide services to you. And let's go back to the PowerPoint, and let's look at that on the PowerPoint, looking at the bottom of the tax bill. So we're back to our tax bill here. Well, at the bottom of this tax bill, I can see every single taxing body that levies on this property. So we've got the College of Lake County. So that's a county-wide tax. So for the College of Lake County, when they're determining their levy, they've got their budget and they say, here's how much I want to fund through property tax dollars. Well, the College of Lake County is going to place that levy on the 18 townships in Lake County, right? So at the county clerk's office, they're going to take the total levy requested by the College of Lake County, and they're going to divide it by the total value of all, the total equalized assessed value of all the property within the county. So to determine the tax rate, you've got the levy divided by the equalized assessed value of all property in that district equals the tax rate. So that's how the tax rate for each individual taxing body is established. Well, let's take a look at something a little smaller. So you've got the County of Lake, 18 townships, County of Lake Pension, 18 townships. But let's look at another part of this tax bill, and let's look at the Woodland Community School District. Okay, so the Woodland Community School District is going to have a levy, so an amount of money that they want to collect from property tax dollars. So we've got Woodland's levy total, and then we're going to divide it by the EAV of all the property within the school district boundaries. And that's going to give you Woodland's tax rate. There's a lot that goes into this process. I don't have a goal of really teaching you all of that today, but just understanding what's going on behind the scenes. So the county clerk's office in the tax extension department, let's go back and look. This is where this comes into play. We've got all of its various taxing districts. They send their levy to the county clerk's office here. And then on the assessment side, we send the values to the county clerk's office here. And this is where they are developing those property tax extension rates. Any questions? All right, so back to the tax rate. So in the county clerk's office, for every single tax district, they're going to calculate that tax rate. Now, what makes your rate on your house? Well, you have to look at where you fit in that drawing. And your total tax rate is going to be all of those individual rates added up. And that's going to be the total tax rate for your property. People don't often realize when there might be a boundary in taxing districts. They're not always aware of that. Any questions before I move on? Oh, PTEL? Yeah, well, we will, what I can do with what I can do with the PTEL tax cap question. So the property tax extension limitation law, it limits how much they can increase their rate. Okay, so it pertains to the extension, and that's what they're calling it when they're requesting that levy, is when they extend it. And so that is what is limited. And it is in Winnebago. I'm guessing your PTEL. That would be my guess. So it's 5%. And if you want to increase your rate beyond that, you're required to go out for referendum. Now, when people talk about adding new construction to the tax rolls and how important it is, it's incredibly important in PTEL counties because the taxing bodies can collect on tax dollars from that new construction without it affecting their rate, that they're limited in terms of how much they want to increase it. So that's the reason why it's really important to identify new construction when you're adding it to your tax rolls. Okay, before we start talking about CEs, I'm going to take another minute and see if anyone's got any other questions on what we went through so far. I don't see questions coming through. So how about this? Have you had any questions in your office that you weren't able to answer? Any questions that took you off guard with any tax bill questions? No, no questions. All right, we will move along to talking about certificates of error. So certificates of error look differently depending on what county you are in throughout the state. We had some registrations from Cook County. Before I go into this section, if you are from Cook County, can you raise your hand so I know if we have anyone from Cook County on the call? Because I'm not seeing the name that was registered. So I just want to, I'm not going to talk about that too much if there's no one here from Cook County.
Or put it in the chat if you're from Cook County too. That works as well.
Yeah, just let me know. And I get to skip a slide if there's no one here from Cook County. So statute for a certificate of error is actually dependent upon the number of inhabitants within your county. Basically what it does is there are a set of rules for those of us outside of Cook County, and there are separate rules, separate documents, timelines, and everything within Cook County. So in relation to certificates of error, everything that I talk about now pertains to all counties except Cook. And then the final slide would be the information pertaining to Cook County. Okay, Jane, great question. So she'd like me to provide an example of when a tax bill will most commonly increase, even though the EAV was lowered or vice versa. Okay, so I'm going to go back to the slide that shows my formula. All right, so here is how. If all of the assessed value in a jurisdiction is reduced and the levy request, the request for money from the various taxing bodies stay the same, then the tax rate itself is going to increase. So what we have on this slide is how to calculate a tax bill, but let's add another equation. So how do you calculate a tax rate? Well, we just talked about that on the other slide. We take the levy, which is the money requested. That's what I'm calling it. And then that is divided by the total EAV. And that's the total value of all the properties in that taxing district. And that gives you the individual tax rates. Okay. So if all of the levies stay the same, so let's say the levy is, somebody pull out a calculator because I'm not doing this. I'm keeping my hands on the keyboard here. So we're going to run a scenario. The levy is $100,000. And in the previous year, the total EAV for the district was $10,000. What is that tax rate? Who's doing the math? All right, give me some numbers, guys.
There's one in the chat.
I lied. I'll check it. All right, so that's going to give us a tax rate of 10. All right, now let's see what happens here. We are going to keep the levy the same. It's $100,000. But all of the assessments increased by 10%. So now our total EAV is $11,000. What's going to be our new tax rate here? That's right. We're going to have 9.09. So in this scenario, same amount of money is going to be collected. But because the assessment was increased, the tax rate was decreased. Okay. Now, if the assessment goes down, the tax rate goes up. That's one part of this, but there's more to it. Let's take a look again at that whiteboard. Okay, so we've got these two houses, right? Well, let's say that we're going to add a few more houses to our scenario. And we've got some houses out here. Well, let's say it's a revaluation year. And these are the only levy that's going to be shared by these two houses here. And the star houses that are outside of that township are going to be those countywide levies. But let's say that these values just dipped. They went way down. They lost a lot of value. So if you look at how the rate's going to be calculated for the county, it's going to say, let's say these values stay the same, but in order to calculate the county rate, they were going to take the total amount of total requested by the county and divide it by the total value of all parcels. Well, if these values, if the heart values stayed the same, but the star values really dipped, the overall value of all the parcels is going to go down, right? And if the total value goes down, the rate goes up. And what that's going to mean is that even if all of the other taxing bodies kept their levy exactly the same, and all of the values in here in this township box stayed the same, if a different township had huge decreases in value, the county-wide portion of that tax rate could increase, which would mean all of these bills would go up. They are holding a bigger share of the tax burden, not because they went up, but because other properties went down. Does that make sense? Does anyone need clarification on that portion of it? Now, remember, these are the most simple explanations. I am happy to explain this to a property owner, but if they have more specific questions about the calculation of the tax bill and which exemptions come up where and how that works, what I have is the phone number for the tax extension department of my county clerk's office. So I'm not trying to do their job. I just want to give a basic understanding, explain my role in the process, and then properly direct them to the experts in any of these given scenarios. And so how much you're willing to explain is going to naturally increase the longer you serve in your current role, the more conversations you have with other people that are involved in the process. But you don't have to be an expert in every single part. You do only need to know who to send them to if it's beyond the scope of what you know. And so don't feel like you have to know everything. I think that's an important distinction to make. But the more you do this, the more you'll end up knowing. All right. Any more questions on that? I'm going to go back to my PowerPoint now. All right, we're going to go all the way to the end, and we're going to begin talking about certificates of error. So what's really important to understand about a certificate of error is that statutorily, and that's why I've included the actual statute here so you can read it, there are limits on how and when these should be used. So a certificate of error should only be sent in when there is an error in fact, okay? It should not be sent in when there is an error of judgment. Okay, so let's talk about that a little bit, because that can be a gray area for some. If you are assessing the property as having a detached garage and it does not have a detached garage, that is a fact. Okay, CE, 2 thumbs up, you can do it. All right. In terms of an error in judgment, if you're looking at a property and you look at the market value and you say, oh, wow, yeah, that really ended up too high based on these sales that came through. That is an error in judgment. And statutorily, it does not meet the requirements laid out for filing a certificate of error. So you cannot file a certificate of error in that situation. So let me throw another scenario at you. And if you're familiar with it, utilize your reaction tools on the Zoom and give me a thumbs up or a green check mark if it's good, and maybe red if it's bad, don't do it. So we have a property where it was a recent sale and the sale was for significantly less than what the assessment is. Would that meet the standard for filing a certificate of error? Is that an error of fact, a mistake in the assessment? Dawn, yeah. Okay. All right, you guys all got that one correctly. All right. It is a recent sale that sold for significantly less, and upon reviewing the property record card, you realized that you have assessed a finished basement that the property does not have. Would that be an error in fact? That's right. You're good to go in that situation. Now, another reason that you're going to see certificates of error commonly are those that are issued due to missing exemptions. So you'll see a significant number of certificates of error that are sent in because a property owner was eligible for an exemption, but for some reason they didn't meet the deadline for having that applied to their property prior to the tax bills being sent out. Now, in your county, so across the state, various counties did this differently, and you have the option due to COVID to have all of your exemptions roll, and those that would require typically a renewal, it was not required for that year, and some counties opted into a second year. So Lake County, where I am, only did 1 year. So the following year, we actually found so many people were coming into our office because they thought they never had to renew it again. And so we ended up having to issue a significant number of certificates of error due to the fact that people didn't do their renewal for that second year. I'm just letting you know, if you're in a county where it's been 2 years, that might be something that you run into this year. So just be aware of that. That's another common reason why a certificate of error can be sent out. Those can be issued at the county level or at the township level. They do require approval. If a township assessor approves, submits a certificate of error, it needs to be approved at the county level. If the county assessor issues the CE, it would need approval by the board review. So just issuing a certificate of error is not enough. You actually do need to get approved. Important things to know about certificates of error. You need to be aware of the deadlines. So be in communication with the treasurer's office. The way a certificate of error works is it is issued by the township or county, and once approved, that information is then forwarded to the county treasurer's office because they create the bills and they need to recalculate what that parcel's bill is going to look like. So just be sure that you know what their deadlines are. They might have a deadline where they're going to stop processing certificates of error October 31st, but they might need the information from you a day before or a week before that. So this is something that's really important, and you need to be in communication with your treasurer's office so that you're aware of when their deadlines are for receiving those certificates of error, so that you don't miss that opportunity. When you do a certificate of error based on an error on the property record card, depending on where you're at in the time frame, you might be sending a CE in and then also making a change for the current year through the board of review. So all of those things can be happening. If you work in a CAMA system, at certain times, you might be locked out of making permanent changes to the data in your system. So you might be able to get a new value, but it's incredibly important that you make sure that the data is updated at a point where the new data will carry forward. And for example, if you're working on current year values and you issue a CE, you need to make sure that you've updated your current year value that you're going to send forward and certify as well. So that's just something that I've seen happen over and over again. So it's really important. Also, know that approval is part of the process. I know I said that before, so I am saying it again. So before I move on, do I have any? Oh, I got a question. Let's see. Can you explain how a CE? Okay, got it. I got the question. So the question pertains to when are you doing a CE, what year is it for, and why is it, why is it a different year? So I'm going to go back to my tax bill portion of my slideshow. Oh, not there, here. There. All right. So you've got your assessment year, and then you've got the year of the tax bill as well. So the 2022 tax bill is going to be paid in 2023. Now, if you submit a certificate of error for the current year's tax bill, for the board of review, that is a 2023 change. It corrects the 2022 value payable 2023. If a bill is sent out in May and a property owner comes in your office after they receive that bill and you issue a certificate of error, after it goes through all the hoops, approval here, approval there, recalculation, the new bill that's going to come out will be reflective of that reduction. So how does it affect what a taxpayer pays? Well, If they paid their first installment, then that adjustment should be made to the second installment. And sometimes you send a CE in after the entire bill was paid. Well, if the whole bill was paid and a CE gets reprocessed, what will happen is that the overpayment portion will be sent back to the property owner via check called an abatement from the treasurer's office. So it is a good idea to speak with your treasurer's office and understand their process. And sometimes you might find something May 1st and the bills are going to be sent out May 2nd. Well, they're not going to be able to go in and adjust those bills before they're sent out. So that's still going to be a certificate of error that comes in after the fact. You need to be very careful with advising property owners of when that bill is going to be reduced, because even if they know that a reduction is coming, if they don't pay the first installment by when it's due, then they are going to be subject to interest and considered a late payment. So you want to be very careful with that. And sometimes those questions, they get in a gray area and they require a phone call. You talk to someone in the treasurer's office, find out what's happening there, and then communicate that information to the taxpayer. Perfect. All right, so any other questions on certificates of error? Okay, I didn't see anyone from Cook County on the phone. Brief overview, they actually have two different windows during which certificates can be filed. There's a window for a certificate of correction. There's also a window for a certificate of error. One thing that's interesting for their certificate of error window is that there is a limit to how much the assessed value can be reduced statutorily there. So we have reached the portion of today where you are welcome to ask me any questions you have. In addition, if I don't see questions coming through, this is also a great opportunity. I see some people on the call that have been in the business for quite some time. So if you have an example of a question that you've been asked that you found difficult to answer, or that you just receive frequently and you'd like to share your answer with the group, go ahead and do that. One other thing that happens in relation to property tax bills is many people they start to question their escrow. And escrow means that their mortgage company is collecting money from them every month so that when their tax bill comes out, they're going to pay it on their behalf. Escrows will also encompass homeowners insurance. So some homeowners aren't aware that the escrow portion of their monthly mortgage payment actually includes the property tax bill, as well as their mortgage insurance, as well as their property insurance. So you need to look at that. Sometimes it includes PMI, which is private mortgage insurance as well. So they can sometimes struggle with understanding what portion of their mortgage payment is being directed to the property tax bills. Sometimes what will happen is, based on where we are in the cycle, they'll get a new bill and they think that they should just divide that bill by 12, and that's how much should be going into their escrow every month. Well, it doesn't work that way. Mortgage companies build in a buffer, so they're not trying to hit that number exactly. Typically, industry standard would be looking at a 5% buffer based on the previous year bill. They have restrictions where they cannot keep too much money in the escrow account. So if they feel like they have too much in there, they've got to shoot you a check, and bring that balance down. In addition to that, they're accounting for two payments. So not just you get the bill in May and it should be your whole $10,000 tax bill. They're looking at those two separate 5,000 payments, and additional payments will be collected in between. Also, sometimes what people will do is, if they have a certificate of error after the bill's been paid, the mortgage company wouldn't be aware of that, and that would affect their escrow collection and adjustments for the following year. So sometimes I will recommend, when you receive your revised tax bill, forward a copy of it to the escrow department of your mortgage company so that they can appropriately make their calculations, specifically if it is a large difference in value. Quad question. Whoop, whoop. Let me go back. Well, quad year is the year that you're not limited to equalization. So quad year is Wild West. You know, you get to create all your new neighborhood boundaries. You've got an opportunity to correct anything. All the board of review decisions fall off. So in my jurisdiction at the township level, this is our quad year. We are not doing equalization. We are doing revaluation. We're creating new land values. We're taking our cost model for our buildings, and we've got a new market adjustment based on the most recent 3 years of closings from within our jurisdiction. And if we do that well enough, we are hoping to not receive an equalization factor from the county assessment office. If we do, it should be a minimal equalization factor. So if you look at that and this is a quad year, or it's a different year and you're trying to justify equalizing, if you have one area too low, they are not pulling their weight. You know, they're like kind of like at the end of the canoe that's being carried with a finger underneath it. So that's really not fair. And our main goal is the fair and equitable apportionment of the property tax burden as a whole. So it's really important for you to be able to articulate in your words, not my words, because we're all going to explain this differently, that if you have an area that isn't valued correctly or where it should be or within a range of where it should be, that means that other values are either paying more than they should or less than they should. So the most important reason is because you want to fairly distribute the property tax burden. In addition to that, I fell into a pitfall years ago in one of my first quads of thinking if I don't have a lot of data in this area, I'm going to be conservative. I'm not saying completely out of range, but conservative, right? So I have a lot of data. What happens then is if you have similar areas and one's a little lower and those start selling, they have lower tax bills. People are willing to pay more for them because they're looking at what they can spend on a monthly basis. That's how people determine what house they're going to buy. 90% of the people buying residential properties, which is what drives these factors. And so you kind of influence the market to some respect. And then what they pay more there for the house because the taxes are low and they can afford more. And then what do we have to do? What do we have to do eventually? We have to raise them. And that can put people in situations where they have a tax bill that they weren't truly anticipating. So it's very, very, very important that you stay the course within a range. Now, I'm not saying huge swings in non-quad years. Sometimes you got to step into it. But in the quad year, this is the year to do it. That's why we have a quad. Everything we're working on for 2023 is for the bill that will be paid next year. So whenever I'm developing information for property owners, I just write all the years. I say tax year 2023, payable 2024. And it's a lot of words and it's a lot of numbers, but that way we're all on the same page of what year we're working with. Thank you, Glenda. Yes, so you can give a brief overview about all the different things that are entailed with an escrow, but ultimately what you're going to do is recommend that they speak with the escrow department of their mortgage companies so that they can look at their documents. And if they have questions on what's been allocated there, word of warning, not all of them have a phone number that's easy to get to. My previous mortgage company, you couldn't talk to the escrow department. Like you couldn't have a phone call. You could only submit emails shuffle through customer service. So just beware, sometimes that's a lot of hoops to jump through and can create even more frustration. So if I can help them figure it out, I'm going to do that because I save them the frustration and I consider it a part of, good constituent service. River properties. All right, Christine, I'll come back to you. I'll come back to that, Christine. What is the best way to advise someone who wants to have their name removed from a bill and then get the current owner's name on that bill? That question would need to be answered by your treasurer's office. So in my jurisdiction, our tax bills are actually generated as reports. So if there's an ownership change before a bill is reprinted or pulled from our website, it will have the most recent owner's name on it. But historically, we weren't able to do that. So the tax bill was mailed out as it was. Now, I did also read, and Brian, I don't know if you followed it at all, but I do believe that there is some, I don't know if Brian's on the call still, there's some pending legislation in regards to requiring some type of reprinting. I kind of wait for those things to be decided and then figure out what I have to do about it. But yeah, you'll need to talk to your treasurer and see how they can handle that and if they can reprint the bill. Most importantly, you do want, sometimes you say we can update it, but it's just going to be for moving forward. So how does this affect being given a multiplier, a township that has very little new residential housing or even commercial property? How does this affect being given a multiplier? Well, it depends on what we're looking at for an equalization factor. So an equalization factor can be developed at the local level. A township assessor can apply an equalization factor based on property class, based on neighborhood. So there's a lot of different ways that it can be stratified at that level. When you're looking at it by equalization by the county assessor or the board of review, they can apply an equalization factor by property class or by township. Typically, they do it by township. When you're looking at it from the state level, the equalization factor is applied to every property within a given county. So it's different depending on which level that factor is being developed at. And I'm not can you give me a little more context about your question if I didn't answer it already? In many jurisdictions, the equalization factors are applied to both residential and commercial property. There are preferential assessments that are not subject to equalization at any level, by the county level or at the state level. Do we have a webinar coming up do we have one on equalization at some point? I think I might.
Yeah, we do have one coming up on equalization. I'm not sure what month it is. I think it's either late summer or early fall, but yeah, we do have one that's going to specifically focus on that.
Okay, perfect. Yeah, so we might be able to cover more of those questions when that new assessor webinar launches. Everything you want to know about equalization and multipliers. Everything you don't want to have to know, but you need to know.
Can we ask a question really quick?
Yeah.
Yes. Okay. John?
I just wanted to know, Chesney, is it common practice or have you heard from many assessors about having like the CCAO not apply a factor to industrial properties or commercial properties that are over $1 million assessed value?
Okay, that's a complicated question. Statutorily speaking, the county assessor or the board of review, so equalization at the county level, they can apply a factor by property class.
Okay.
Now, in terms of how the equalization factors are determined at the county and the state level, any property that has an assessed value of $1 million and over is not included in sales ratio studies.
Correct. But they're still going to get a factor though.
Yeah. So it is something based on statute that is absolutely allowed. I haven't gotten wind too much of where that's happening throughout the state. In my jurisdiction, it's applied to everything. Now, I'm not not speaking under the banner of IPAI, I really don't know that it's appropriate for our residentially driven equalization factors to be applied to commercial property. I'm not really sure that that's appropriate, but there are many considerations in that argument. There are arguments on both sides of that. So that's just, but this is how it's been done here. There'd be a lot of things to consider if you didn't do it too, if you tried to change course.
Because I've been asked by attorneys too during the hearing process, how come I apply a factor to these properties that are maybe $10 million AV, assessed value, when we know that the factor is going to be huge, and to be applied to a factory or something like that year after year after year, it was just brought. Okay.
Two things. Number one, if an equalization factor, is applied, removal of the equalization factor is not a valid reason for appeal. However, if the results of that factor are basically creating a value that's out of whack, other information should support that contention. The income should support it. Comparable sales could support it. So those reasons. Now I know that people go, there's things that happen and they're always allowed until someone gets caught and people say, oh, maybe you're not supposed to do that. So always be careful that just because someone is doing it and no one has said anything about it, that doesn't mean it's legal. Just like speeding, you speed all you want to, you only get in trouble for it when you get caught. So just keep that in mind. It applies to this as well. But if it is creating values that are out of whack, it should be evident based on sales, based on doing an income statement, based on cap rates. They should all support that contention.
Thank you. Thank you.
You're welcome. No easy answers here with assessment stuff. All right, well, everybody's dropping off. I'll stay on see if we have any more calls or questions.
Chesney, I actually had a couple questions come through about your presentation, the visuals of it. I had someone ask if they could get the graphic that you have for Lake County on the tax bill and the tax cycle and the assessment cycle. And then someone else just put in the chat about getting a copy of the PowerPoint as a PDF.
Okay.
So if that's something you're okay with sharing the final with me, I can share it with the group.
Yes, absolutely. And the communications department of my county, when they shared that infographic with me, we used it in a course and they said, you can share it with whoever you want to. And I think that's pretty cool because we're all on the same page. We're trying to educate the public so that they understand what our constraints are and how things work. So, yep.
All right, so I'll get those from Chesney, and then I will send out an email to everyone that was registered for the webinar today and have those as attachments. So be on the lookout.
If you're going to do your tax bill, you should make sure that you take a sample of your tax bill because it's going to look different. And if you've got like a Lake County tax bill and yours looks like an Adams County tax bill, that's not going to be helpful.
All right, sounds good. Well, I know we went a little bit over, but thank you all for asking your questions and for attending today. Our next webinar will be on May 16th, and our topic will be assessing new construction. So hope to see you then. All right, meantime, thank you for joining us. Have a good rest of your day.
You too.
Thank you.